And the small buyer says, well, how much can I afford to pay? Right? The mid-market buyer says, what's my rate of return? The big buyer says, what's going to do my stock price? Private equity firms tend to be EBITDA driven with a view towards the exit. Our job is to try and make a sense of this soup for our clients. Private equity firm says, why isn't my money working? Well, because you don't have the opportunities and the benefits of the guys you're competing with.
So, hey, welcome back to the Aerospace Executive Podcast. I'm doing my quarterly check-in with my good friend and sell-side investment banker, Bill Alderman. Bill is a phenomenal investment banker in middle market, aerospace and defense, and he always blows me away with his take on the market. And today we're talking about valuations. Bill,
Yes,
good to see you.
Craig, good to see you. Am I going to see you, by the way, in October? You going to NBAA?
I will be in Vegas. I will be in Vegas for 36 hours.
Yeah, I'm going to be there for like 18. But at least two of our partners, me, one of them, will be out there for the whole show. And I'm going to be out there at least for a little bit. So we will definitely find coffee in the halls. Look forward to it. Yeah, so we haven't done this. I mean, we talk every quarter about value, but we've never actually talked, Craig, about how do you go about valuing a privately owned company, right? So I thought it was timely. We're having a lot of conversations right now. The market's very active. We're having a lot of conversations right now with people about, well, why did this company sell for that price? And why did that company sell for that price? And why is that company trading for that price? And not that I am the guru of valuation, right? I mean, Warren Buffett can keep that title, right? I don't want to go anywhere near trying to be that. But in our little sandbox of selling middle market aerospace and defense companies, we've just seen it all, right? And sure, you know, my guys and I all have MBAs and we all went to grad school and read the textbook, How Do You Value a Company? But, you know, 25 years of having this firm and boots on the ground, we have a pretty good sense of how companies get valued. And the textbooks are relatively accurate, but let's talk about what really happens in the trenches because, you know, you have your plan for warfare, but the fog of war changes that a little bit. The enemy changes that a little bit. And then the way you fight war is try to win the war, right? As opposed to follow the textbook before it started, right? So
in the great words of Mike Tyson, everybody has a plan until they get punched in the mouth.
Right? Okay. So let's tell you what we've learned over, I think it's like now 25 years, just about 25 years since we started the firm. And I'm going to try and break it down and make it a little weird, a little complicated. If I go nuts, just pull me back to reality. And I'll try not to go too far down too many rabbit holes. High level, the way we see the market, our market, right? Middle market aerospace defense. There's obviously larger middle market, smaller middle market. But for our clients, they're maybe sometimes less than 20 million in revenue, maybe less than 50 employees sometimes, and sometimes more than 150 million in revenue and more than 500 people. But that's the parabola, right? In that market, we see three kinds of buyers. Okay. Large, medium, and small. And it really matters. Okay, and I'm going to talk about specifics. And there are also different types of small, medium, and large buyers. We call them institutional and corporate. Okay, institutional means, and it gets a little weird, so let's just keep it simple. There are companies that buy companies, and there are institutions that buy companies. Yep. Private equity firms is the classic family office, things like that. We don't deal with what we call the dentists from Duluth. Okay. There are dentists from Duluth that buy real estate or whatever, and they may buy a piece of a company or their cousin's business, or they may buy a business they buy a car wash downtown, right? While they're being a dentist in Duluth. We don't deal with that at all, right? And there's a business broker market, a large one in the world, in the United States, where if you want to sell your dry cleaner and you're looking for someone that would own and operate a dry cleaner, there's a market for that, okay? They're brokers. We don't deal in that what we call dentists from Duluth market. Okay, so just I don't understand it. I don't know how people do those deals, how they value them. Just not saying it's bad. It's just we don't have any experience. Okay,
Right.
so we're dealing with that company that's got some size, 50 employees, 10, 20 million in revenue minimum, 2 million, 3 million, 4 million in EBITDA minimum. That world. Okay, in that world, there are small buyers, middle buyers, and large buyers. If we're selling a company and we go to the market and the market speaks and the three people that are interested are all small companies, okay? No dentists from Duluth, right? No big private equity firms, no public companies. It's just we're dealing with other small companies, okay? A lot of your kind of clients are the buyers, right? How does $100 million privately owned business go about buying a $20 million business? How do they value it? Okay. Let's just call that small company buyer.
Okay.
The mid is, well, I've got $600 million in revenue. I may be a public company. I may have 300 shareholders. I may have 30 shareholders. Or I may be owned by 4 different families. But I'm a mid-sized real company that's not publicly traded. Okay. How do I go about valuing that acquisition? Okay. We'll call that the mid company buyer. And then pick your favorite company. I'm Northrop Grumman. How do we go about valuing $30 million companies? Okay. Companies, mid, small, large, private equity. Okay. We're going to talk about the mid private equity firm and the very large private equity firm. There really are no small private equity firms because it gets really small. If it's Craig and 2 of his buddies managing their money, you may legally be a private equity firm, but you're not a $300 million private equity firm. Okay?
Right.
All right. There's my landscape. They all do it differently. Every single one of those 5 values companies totally differently. And when people say to me, well, what's the EBITDA multiple? I'm like, well, why are you asking that question? Are you targeting a specific market? What's the DCF? Well, why are you asking that? Are you targeting a specific buyer? So let's talk about how these groups, for the most part, value a business, and they obviously can overlap, right? But let's talk about how they do this. So how does a small company value another small company? They do it by how much they can afford. They may do comps, they may do DCF, but that's not their driver. You know, the driver is, we get $1 million in cash. We can get an SBA loan for $2 million. I think the real estate, we can get a $2 million mortgage. We can pay $5 million for this business. That ain't a DCF. That ain't comps. They may look at that stuff, but what's driving that buyer? How much money they got. Okay? So when someone says to us, we're going to sell our company and these are the likely buyers, how's it going to be valued? It's going to be valued on financeability. You got a lot of hard assets, it should be financeable. You got no hard assets, maybe hard to finance. Okay? All right. We can come back to that in a bit, but let's move on to the mid. So you got $400 million in revenue. Your business is owned by 3 or 4 families. How do you value the companies you're looking at buying? Really? For a $30 million acquisition, you're worried about financeability? You probably got a $100 million line of credit. You probably got $20 million sitting in the bank. Financeability for a $30 million deal isn't what you're thinking about. You may look at it. You may have your CFO run some models of if we put 20% down, what would the debt service ratio be? You may look at that stuff. It's not your driver. When the families sit around and say, should we do this? They're probably using something like payback ratio, internal rates of return, discounted cash flow, comps. What are other companies like this trading for? But here's a funny one. Are they going to look at something like earnings per share? Why? Would they look at accretion analysis? Would they look at the impact on the stock price? They don't have stock price. I mean, they may have a stock price, but you can't go on the computer and say, "Oh, did that work?" Right? Okay. All right.
I gotta assume something like that. You know, you're just looking at, hey, look, we're borrowing money at, we got 4 families. We're worth, between the 4 families, we're worth $1 billion. We're borrowing money at 5.5%. What's our IRR? What can we make on top of that?
Should we buy a $30 million machine or set up a greenfield $30 million factory? What's got a better rate of return for the families?
Yeah.
Right. Of course. Okay. Now let's do the large public company. Same deal. I mean, look, we're selling the same little $30 million company. And the small buyer says, well, how much can I afford to pay? Right?
Yep.
The mid-market buyer says, what's my rate of return, as an example? Right? What's the big buyer do? The big buyer says, what's going to do my stock price? I mean, I'm a CEO, I'm a SVP, I'm a CFO of a public company. I have stock options. I get bonuses based on stock price. It's part of my annual compensation, right? Or maybe I have a EPS target, whatever I've got in my little pay package, earnings per share, growth, or whatever. So what do I think about when we're doing acquisitions? When I go to the board of directors, what are the board worried about? Stock price. So when you're dealing with a very large public company, it's all about stock price. What's this going to do to the stock price? We buy this $30 million company, it's going to be accretive to earnings. The stock price should go up.
Or something different. Do I just want to put somebody out of business? What's it worth? What's it worth to me to put that $30 million company out of business? Or the tech landscape. In the tech landscape, what's it going to cost me just to get their employees?
Yes.
Is it cheaper for me to buy the company than it is to go grow a team of employees?
Yes.
Apple, those guys. So,
but that's
tremendous variables.
Correct. But what's the driver? In other words, people say to us, Bill, what's the driver of my value? Right. And everything you just said, I agree 100%, goes into the mix. But what's the driver? Right. Getting ahead of that buyer. What's their number one motivation? And obviously, you never really know, right? But we get asked, so we got to answer. Let's flip over to private equity firms. Right? We just did companies, mid, small, large. Let's do private equity. Not a lot of variance here, and we're going to ignore the private equity firm that's so small. They're not really a private equity firm, okay? Search funds okay. So you're a private equity firm with $600 million under management. How do you behave, right? Well, you're going to try and buy a company and flip it in 5 years. Roughly speaking, have a gain, and you have a waterfall and a thing for you. And if you do a good job, you guys get to keep some of that. That's how private equity firms work. So what's your focus? Well, your focus is, can I sell it for more than I paid it for it? That's what you're worried about. Right? So if I buy you at a 5 multiple and your earnings are stable and I can sell you for an 8 multiple, I make money. Or if I buy you at a 6 multiple and your earnings go up a lot and I sell you for a 6 multiple, still I made a lot of money. So private equity firms tend to be EBITDA driven with a view towards the exit. Not always. Some of them are more IRR, DCF-ish, but they're very focused on building something I'm going to sell for more than I paid for it.
Right.
Very large private equity firms have a slight twist, because very large private equity firms often will sell their company to the public, IPO, right? Not always. Every deal isn't like this, but a lot of private equity firm exits are to the public IPO market, okay?
Yeah. Standard Aero. It gets so big, no other private equity.
Yeah. 100%. Carlisle did a great job, built Standard Aero, was patient, took it to the IPO market, and did very nicely. Okay? So that's also a build at a price to exit at a higher value. So we have 5 different ways of thinking about value.
Right.
Smaller private equity firms tend to be exit value driven. Big private equity firms tend to be IPO exit driven. Not always. Large public company buyers tend to be earnings per share accretion driven. Middle private companies tend to be IRR, DCF comps driven. And small buyers tend to be financeability driven. So bottom line is, and I'll turn it back to you, our job is to try and make a sense of this soup for our clients. If we see a transaction is probably going to attract large public companies, we will say that your valuation may be EPS driven. Okay. And oftentimes, financeability is the lowest value, IRR DCF is a mid value, and earnings per share is the highest value. Okay.
Right.
But we spend a fair amount of time trying to help our client understand before we go to market, what are you likely to see and why in valuation? And it's not that it's overly complicated, but it really matters. You can't just say multiple because that only applies really to one of 5 types of buyers.
So what's interesting is, looking at what you're talking about, as we go through a couple of multiples, Standard Arrow,
Yeah.
something like 66 times, Lore.
Is that EBITDA or PE? Which multiple?
I'm looking at price. All right, I'm looking at the price to earnings.
No,
I got CNBC up on my.
No, but still, but price earnings.
I got 171 times on Lore.
Yes.
VSE, Cuomo's done a great job with VSE, but he's selling at a unbelievable multiple. And then, I just look at GE.
Mm-hmm.
GE is it? I think I looked at it the other day. Am I a buyer of it at 47 times? I love the model,
Right?
but I don't like the multiple. And maybe things have changed. Maybe the world is changing. I don't know. Yeah, but I think in your world, the challenge is, I'm hearing a lot of private equity groups tell me they're out scouring the market. They want to do acquisitions, but they're looking at things and everything to them is quote unquote expensive.
Mm-hmm.
The small company, the small company with 5 million in, 5 million revenue,
Mm-hmm.
million and a half and million and a half, 2 million in earnings.
Yep.
No.
So the issue with and those are very small companies, right? And we tend not to work in that market. So I can't really shed a lot of light on what you're hearing about those kinds of companies. But if we go upstream just a little bit to 25 million in revenue and 4 million of EBITDA, 5 million EBITDA in that range, maybe 30 in revenue, whatever, upscale a little bit. We are hearing from private equity that things are getting expensive. But if you look at the cycles, right, and I've been through many because I started the firm when I was 40 and now it's 25 years later. So I've been doing this a while. And I was, this is all I've basically ever done all my life, is M&A and aerospace defense. The cycle becomes, I would say, less favorable. I wouldn't say it's hard for private equity, but it's less favorable to private equity at times when the strategic buyers, the companies, are acquisitive because they can crowd them out. And we view a private equity firm without a platform, meaning they've got nothing in the sector yet. Okay. It's very hard for them to get a toehold because they've got no available synergies. And I hate buzzwords. I do, Craig.
Yeah.
So let's not use buzzwords. They don't have the ability to absorb excess overhead. There's no redundancies, and they can't leverage their existing sales force or operating talent, right? When two like companies merge, there are things they can do to be better, right? We have a CFO, you only have a controller. Well, we're going to have to hire a CFO at our controller company, and well, we don't need to now because you've got one, and so we can save that expense going forward, right? And we were going to need to build more space because we're out of space. Well, we've got excess space, right? All those things, I hate the word synergies, but opportunities to be more efficient by being together. Oh, you've got a salesperson in California. We were going to have to hire one, or we don't have one. We're not covering the market properly, et cetera, right? So there truly are benefits to two like companies merging together and having the ability to do more without spending a lot more, right? And be able to cut some costs. That's legit. Well, if that really is legit, then comparing the company buying another company to a private equity firm that's just got money and has no platform, well, of course they're at a disadvantage. So, of course, to them, it's more expensive because if you and I are going to do a deal and I'm the same business as you. We're both making aerospace widgets, right?
Mhm.
And we can sit down in the conference room and say, look, oh, you've got that salesperson. Oh, I need that salesperson. Oh, you've got somebody in Europe. Oh my goodness gracious. All these things we can do where I, as a buyer, say, you know what? He wants a lot of money, but it's worth it because we can do all this stuff together. I'm going to make a ton of money, and whatever valuation method we use, it looks better on paper. If I'm a private equity firm, all I'm doing is paying more money. And so we are at a moment in time when there's a lot of strategic opportunity where companies are buying companies. And therefore, it's just a point in the cycle where the private equity firm says, why isn't my money working? Well, because you don't have the opportunities and the benefits of the guys you're competing with.
Right. Yeah. There's a lot of competition out there right now. Look at public companies, Standard Aero, Honeywell, lower borrowing costs.
Yep.
If they want to borrow at all, they may just, like a $30
Penny
million
cash.
petty cash. It's like, just buy it. We don't care. And they're just doing an IRR. They're just doing an IRR deal. I mean, it's like literally just go buy it.
Or EPS, or whatever.
Yeah, we can go buy this guy. It's a buy versus build. Let's just go buy the guy.
Yep.
We bring in the capacity. It's an IRR deal. Or if I'm Honeywell or GE, my borrowing costs are next to nothing. I can go float a bond out there. I can go float some debt out there on the market at what's 5.5% right now.
Cheap.
If they're getting, if they're not getting 20% IRR, somebody's getting fired.
Right.
And how much, in your opinion, let's talk about the other side of it. How much is the leadership in the company an adder or a detractor to the price that somebody's willing to pay?
It's a great
management quality.
Yep. It matters a lot. If the buyer is a unique buyer and they're going to put their entire management team in place, which is seldom, especially in our market. But if they're intending to completely roll over the management team, you would argue that it doesn't really matter. How often have I seen that in my entire career? Like once, literally. And I've been doing this for 15 years before I was doing my own firm thing. So 40 years, saw it once. What usually happens, buyers view the management team as the most important intellectual property they are acquiring in the transaction. Now, you can't acquire people. You can put them on 3-5-year employment agreements, right? Mm-hmm. But in most cases, these smaller companies are very sensitive to who's running them. We get asked all the time in due diligence. We see our clients every time. Who owns the customer? Who has a customer relationship? You got 5 really important customers. Who do they call when there's a problem? Do they call the salesperson? Do they call the person in the corner office who's the owner? Right. These questions actually really matter to buyers. Okay. When the shop floor has a problem, who does everybody go to?
Right.
That person may be the whatever, but who does everybody go to when a machine breaks down? Right. Mm-hmm. Those questions get asked and the answers matter. And we oftentimes work with clients to fix problems. And you've seen it, Craig. We worked with you where someone's retiring, great, wonderful person, but they really want to retire. You can't sell that business with that person missing the day after you sell the business.
Right.
So, Craig, we need to find number 2 and train them to be number 1. So in 2 years' time, when Mrs. Johnson wants to quit, Mrs. Johnson can just walk away and your new hire that's been the COO says, everybody reports to me, and when a machine breaks, they call me. And when a customer's have a problem, they call me. And Mrs. Johnson doesn't work here anymore. You solve the problem, right? And so we've worked together on this, Craig.
Yeah.
It matters. And so I'll say what I just said again. If you're the owner founder of a small company and you want to retire in 3 years, call my buddy Craig, find a little version of you, train them, and then you can retire, because you will lose millions and millions of dollars if you think someone's going to pay a lot of money for your company and in 6 months you're going to be gone. You will lose millions of dollars.
I've seen that happen. Won't say the company, but private equity group had no business being in the industry, first acquisition, and they bought a company. And the tribal knowledge that was in the owner's head was invaluable to them.
Mhm.
but they kept discounting. And they kept discounting him out. We don't do it like this. We don't do it like this. We don't do it like this. He gets frustrated. He goes away. They have no idea how to run the business.
Not happy.
And the business is no more. 3 years later, the business is no more. And, prior owner calls me back up and says, "Hey, I want to get back in the game. How do I do it?" It's interesting to see that. Why would you buy somebody's business and then discount them and tell them they don't know what they're doing? Well, obviously they did.
Right.
We've seen that. You've probably seen that a couple of times as well.
Yeah, and as a sell side banker up front dealing with that issue, we have many times, Craig, explained, especially to the founder owner that wants to retire, you have to have your number two in place before you go to market. Because otherwise they're going to look at you and say, "No, I want you on a 5-year contract," or "No, I'm going to do an earnout," or "No, I'm doing a massive holdback," or because they don't want the risk, and you can't blame them. Right. Mm-hmm. So we have, I remember one we did years ago. The founder's name was Bob, wonderful gentleman. And we literally orchestrated a plan where within 6 months prior to going to market, he was allowed in the building 2 days a week for 3 hours. That was the rule. It was the rule. You can visit your company twice a week for 3 hours. For the 6-month period before we go to market, your number two has to truly be running this business, or I'm not taking you to market. I swear to God. And Bob did a phenomenal job. And his number two today, I'll give you his first name, Greg. Greg is now running a $100 million business at a public company. Okay, he's running a $100 million division of a public company. Greg was a shop floor person at the beginning of his career, and when I said to Bob, this is a long time ago, "Bob, you need number two. Want to go recruit?" And he goes, "No, there's a young man on the shop floor, ex-Air Force. Really like him. I think he's got talent." I'm like, "What, MBA? What?" No. High school degree, A&P mechanic. And I'm like, "I'm going to meet the guy." And I'm like, "This guy's smart as hell. And I'll go get her." And so we spent about 9 months helping Greg. And Greg's phenomenal. But when we went to market about a year and a half later, Bob sat in the back of the room and said, I play golf. I come in 3 hours a week, 3 hours a day, twice a week. And Greg runs the company, and the buyers fell in love with him because he was that talented. And of the most important things that we do for our clients, it's not multiples and calculations of spreadsheets. The most, I think, the greatest value we bring to our clients is just visibility. They've never sold their business before. They don't know how the buyers think. And helping them see what's downrange is the greatest value we bring to our client. And all we said to Bob was, "Bob, you got to have your number two now, not later." And he's like, "Well, I know the guy. He's in the back there. Let's get him ready." That's okay. If he hadn't done that, he would have gotten a lot less money for his company.
But that's the whole, the big conversation with entrepreneurs, and they're not so good at doing this, is what's your succession plan? What's your
100%.
What's your protection to your family if you get hit by a bus?
Mm-hmm.
And there's nobody behind you to run the business.
What's your plan?
What's your plan?
I mean, these entrepreneurs, they're all very talented. They wouldn't be where they are if they weren't that talented. They take care of the customer, great at production, services, whatever. They're like the accountant that has lousy books and records, right? Mm-hmm. Or the dentist that has bad teeth, right? Right? How do you find a dentist in a really small town? Look for the only person in town with bad teeth, right? Get it? Right? Because there's no dentist to go to, right? These entrepreneurs tend to do everything incredibly well, aside from think about their own wealth, actually, right? Mm-hmm. Some people are fraudsters and hucksters, and all they're doing is trying to make a lot of money. But I'm talking about the real passionate entrepreneur that's making widgets because they love making widgets. Mm-hmm. A lot of these people they're not thinking about doing this to create wealth, doing this for my family. And And I'm not saying you should be, but when you get to be a little later in life, you should be thinking about, you're working 100 hours a week, you're missing your kid's baseball game. Why? And if you're building a company that's worth a lot of money, shouldn't you protect it and nurture it and maximize it?
And have somebody behind you. But that's but that comes down to, how do you value a company?
Exactly.
If a public company wants to buy that person, they don't really care, because they'll go find some GMs, or they'll go find some other executives in a role that can step in.
Yep.
That person steps out. But if it's private equity,
Mm-hmm.
their options become, we got to go hire somebody.
Mm-hmm.
We'll go hire a team, or we have an operating partner step in
Mm-hmm.
and drive it. But that comes at, a hit to valuation. So, a couple things.
The key is to know your audience, right? That if I could leave your audience with one piece of wisdom, it would be, if you own a company, you should be thinking about the exit. Even if you're 38 years old running your company, you should be thinking about your exit every now and then. Don't just work your tail off and not think about the opportunity to create wealth for your descendants, family, whatever. And the other is, know your audience. I mean, if you're building a small company in aerospace and defense, and your children are going to go into the business, great, you have a plan. If you have no children in the business and you're building a small aerospace and defense company, what are you going to do? Right? I mean, someday you're going to stop working. Worst case scenario, you're going to get hit by a bus, God forbid. But what's the plan? And know your audience. And, don't just talk about multiples because the friends at the country club talk about multiples. That's not how it's done.
Right.
In one of 5 markets, that's how it's done. Is that your market? If it's not, smarten up, understand your market, and get a sense of where you're headed, and off you go. It's not that complicated, but it does require some thinking.
Well, definitely it does. And a couple of things, like I learned a lot in these chats with you. You talk about sellers, 5 years of solid financials,
Mm-hmm.
the importance of a good CFO. I just did a podcast. I think the CFO is more important. I think the CFO is the most important person in the company. Number one, CEO could go away tomorrow, and the CFO is
Make or break you.
5 years of good financials, a good long-term thought process. Now, as an investment banker, you take companies to auction.
Mm-hmm.
Are you immediately throwing out people that are coming to the auction because they don't have the pedigree?
We try to be very client-centric, okay? And if our client only wants to sell to a public company, if that's feasible, we will work on that. If our client wants to sell only to an American private equity firm, we'll work on that. If they want to include British private, we're trying to be very client-centric. And so I guess I'd answer the question by saying, what is the client looking for, balanced with, do we think that's a reasonable expectation? Mm-hmm. Does that answer your question?
It does. Yeah. It's all about who the seller is willing to sell to ultimately.
Yeah. And look, a certain seller might offer different valuations, right? So one of my favorite little anecdotes I tell clients is, look, you can put restrictions on this thing. It's yours. You can't violate laws about, race and religion, but anything else, do whatever you want. I don't want to sell it to a company from Europe. You don't have to. There's no law that says you must, right? Mm-hmm. But the silly extreme I share with clients is, you could say to the buyers, I want to paint my building pink the day we close, and you've got to leave it pink for 7 years. You can require that. There's no law that says you can't. I said, you're nuts, and you'll lose 30% of the value. But if that really makes you happy, we'll put it in the requirements. We really do. I really do say that to our clients. Okay, now, what does it mean to someone that is a not credible buyer? Okay. Well, if someone has no money, right, is a friend of a friend who knows a guy who, we say to our client, you're probably wasting your time here. if you want us to include them in the process, we will, but why are you doing this, right? So we'll probe and we'll ask. But within reason, as long as we're not breaking the law, client asks us to say you got to paint the building pink and keep it pink for 7 years. Okay, off we go. But just understand, you just lost $4 million by doing that.
Yep. So last question.
Okay.
Before I see you in October, before I see you in Vegas. Yeah. Last podcast we did, why machine shops are now worth a fortune.
Mm-hmm.
Yeah. Lohr, VSE, GE. I actually got a lot of money in Safran, and it's like I can't figure it out. It's the slowest, it's the slowest moving one of the group. That's kind of the way I typically pick stocks, though, I think. Is this bull market? Everybody is telling me that it's hard to find good companies and they're selling at a premium. Are we in this market for a while?
All right. So I'm not a market stock picking guy, right? I'm not. I will say this. I think that we're in a very good market for aerospace defense M&A. Okay. Mm-hmm. In part because the overall economy and stock market and capital markets and debt markets are functioning well. Right. Are there risks that those markets could have some stress? Yeah, I do believe there's some risks that stress could be out there, but there are better economists and better market people out there saying those things than me, right? What I would say is that if those markets have stress, it flows down. Okay. If the debt markets become tighter, if the equity markets drop a little bit, if interest rates maybe stay stable, but banks are less willing to lend even at favorable rates, if any of those markets moves downward, it has repercussions throughout the entire system. Okay, some of these markets are affected more. So the small buyer that's worried about financeability and the banks are getting tighter, well, that affects them more than all the other buyers, right? And the price earnings ratio of the public companies, well, if their PE ratios come plummeting down, that market may change. And so, A, it depends on the segment we're looking at.
Yep.
B, it depends on the exogenous shock that's going to hit. Little shock here, a little bit of movement. Big shock across the board, like the pandemic, we're all going to suffer. Do I personally see something on the horizon that's got me worried? No, I don't. But
either.
Craig, you got better people on this podcast than me to talk about the markets.
No, just from a business seller standpoint. I mean, it's there's, I just know what people are telling me. It's like they're looking at a lot of deals and they're getting, there's not, the stuff they're looking at, it's getting smaller and smaller and smaller, which makes the prices go up and up and up. And I'm looking at the industry right now, and I see a lot of opportunities for companies to make a lot of money out there. That's kind of my, I'm very optimistic on our industry. Right now.
I think what I'm hearing you say is that it's somewhat of a seller's market at the moment. That if you're selling your company, you're getting good prices, and some people are squawking that prices are too high. The buyers wish prices were lower. That sounds to me like the language of a little bit of a seller favorable market. And I would agree with that. And we've got numerous deals in the market right now, which one or two I think are highly likely to close by year end. And so we think it's a very good market. And so I'm not surprised that there may be buyers out there that are saying it's too good of a market for sellers at the moment.
I love it. Let's get a drink in Vegas.
I look forward to it, Craig.
Awesome, Bill. Thanks for coming on.
My pleasure. Thank you.